So that is, up to this point, looking at these entities and how you analyze them in terms of the impact they have on a larger primary government they're a part of. So let's shift our focus now and look at how you might analyze them as freestanding entities, particularly these ones that are reported as component units, or that are just totally freestanding and aren't part of any larger government at all. Um, Whereas our focus up to this point on general purpose governments has been on the health of their economy and what it does for their ability to raise taxes, in particular property taxes, income taxes, sales taxes. The analysis for a BTA is focused predominantly upon what that entity does, what it charges for what it does, and the degree to which its charges for its services or its goods are sufficient to cover the costs of providing those services or goods. So there's a lot of revenue and expense analysis involved here. Uh, you're also going to look, because their revenues and their costs are related directly to what the entity does, you're going to want to look at how much it does, what type of demand there is, and unlike what you have for general purpose governments, whether there's some competitor out there that is trying to serve the same group of customers. Something like mass transit. There may be some private bus companies that provide transportation as well, but mass transit is going to tend to dominate the transportation market. But colleges and universities, hospitals, utilities, all may have direct competitors that are both for-profit entities and not-for-profit entities as well. That's obviously the case in healthcare. It's the case in higher education as well. Revenue debt analysis is very different from the analysis of tax-backed and general obligation debt. We touched upon this very briefly in the unit on debt analysis, but now let's take a little bit closer look at what factors are important when you're looking at revenue debt. One of the very first things they're going to look at is the legal aspect of this. What type of, what is securing the debt? What's the revenue source that specifically that is meant to repay that debt? And what limits are there on the entity's ability to raise that revenue? For instance, are they allowed to just increase their rates if they need to, or do they have to obtain approval of voters or another level of government? Is there a regulatory board that tells them whether they're allowed to raise rates or not? Flow of fund structure is looking at how their flows of resources coming into the entity are set up in terms of what they pay for in what order. It's very closely related to this concept of priority of claims, but priority of claims is a legal issue, whereas flow of fund structure is the way that revenues flow into the entity and how they are set up in order to pay for the operating costs of the entity and the non-operating costs, including the repayment of long-term debt. Priority of claims is looking at the legal documentation that goes along with the debt issuance and what it says about the place of the bondholder, the buyer of this debt, in relationship to other creditors in terms of when it's going to get paid. There are certain types of debt that are sold that tend to be a little bit more valuable because they come with a promise that when there are competing claims on the resources of the government, that this is the debt that gets repaid first. It has a primary claim over all other creditors of the entity. And as you can imagine, from a bondholder's perspective, that's a pretty valuable promise. Because you're looking at debt that is being repaid with a particular revenue stream or a couple of revenue streams, analysis of that revenue is the most important part of the analysis of whether the government has the capacity to repay that debt. We've already talked about coverage ratios. The same types of ratios are going to be used here. Times interest earned or interest coverage, debt service coverage. They're going to look at both what the government has actually done, which gives you a sense of the amount of flexibility or slack it has in terms of available resources for repaying debt. And it's also going to look at this as a legal or compliance matter because generally revenue debt issuances have legal protections in terms of a required level of coverage. And they will specify how that ought to be calculated, which may be different from the way that it's calculated in the ratios that we've been looking at. They may include certain expenses and exclude certain other expenses. That will all be laid out in the legal documentation for the bond issuance. And often the reason that requirement is in there is because it says that if a government doesn't achieve that level of coverage in a given year, that it is in technical default, meaning the bondholders could step up at that point and demand that the government, make good at that moment, repay all of the amount that's still outstanding on that debt. Generally, that does not happen. So an entity may be in technical default, but it continues to make its debt service payments as they come due without any issue whatsoever. And so that doesn't tend to set off any alarms unless there is some additional indication that the government isn't able to make its debt service payments. There's going to be a lot of analysis, as we looked at in revenue analysis, of the rates that the entity charges for the services it provides, the base that it charges it against. So if it's a water utility that's charging based upon the consumption of drinking water, you're going to look at information about the amount of water that's been consumed over time and whether that's on the rise or if it's falling. That's closely related to this issue of demand for service. Particularly if it is an entity that provides a service that is being provided by other non-governmental entities, either profit or for-profit entities. Who's out there? How much do they provide? What's the total demand for a particular service? And how many entities are competing to be the entity that meets that demand? And then you're going to look at, as you would at tax-supported debt, at economic and demographic information that is relevant. Not all economic and demographic information is going to be relevant, but there are some particular things that are relevant. For instance, if you're looking at a public college, the college-age population is going to be something that's important. The number of students that are graduating from high schools in that general area is going to be important information for them. Personal income levels are important to them because there are some demonstrated relationships between the demand for college and growth in personal income. Unemployment rates are important because when unemployment rises, some people, instead of trying to find a new job, will decide to go back to school in order to qualify to get a different kind of job or a better job than they had before. And so it's not unusual that when unemployment rises, enrollments in colleges and universities rise as well. There's also this thing in revenue debt analysis called the additional bonds test, which is a way of looking at whether the government can sell more bonds that have an equal claim to that pledged revenue. So not looking as you would at the general resources of a general purpose government that's selling GO debt, but specifically, can this government sell more debt that is being repaid with that same revenue that's already been pledged to repay other debt? And we're not going to look any further at that. That's a degree of detail that is beyond what we're looking at in this course, but it's important to understand that that's a key thing that analysts of revenue debt are looking at. And it's not hard to understand why. If they've already got some debt that is being repaid from that revenue source, they might be alarmed if the government is going to issue more debt that is going to have a claim on that same revenue source. And they might want to look at whether they really have the capacity to pay any more debt out of that particular revenue source without increasing the rates or greatly increasing the amount of service they provide. You're obviously going to want to focus on indicators of operation and of competitiveness in terms of looking at not just whether they can repay their debt, but whether they're financially healthy as a whole. If there isn't a sufficient amount of demand for their service, a BTA is going to be in real trouble. And either it's going to have to change its structure or cut back on its operations, or potentially go out of business because it's not competitive with the other providers of that service. So, for instance, if you're looking at airports, they're looking at O&D, origination and destination statistics, the number of arriving flights, the number of departing flights, the number of passengers on those flights. You're going to look at nearby airports because those are the ones that they're directly competitive with. You may look nationally as well if you're one of the larger entities, because you might be able to make an argument that for instance, the three big airports in New York City are competitors with Atlanta or Chicago or Boston or Philadelphia, or even further with Los Angeles or San Francisco, in terms of particularly where cargo comes in. Where is that going to enter the country before it is then distributed to the various parts of the country? Being that entry point can be very important. But for the most part, when you're looking at smaller airports, you're comparing them to other airports that people in that area could easily drive to as an alternative, or other types of transportation like buses or trains that they might use for regional transportation instead of taking a flight. Hospitals, there are a wealth of patient statistics about inpatient care, outpatient care, the type of care that's provided, how long people stay in the hospital when they enter for a particular service, mortality statistics, how often people die when they are receiving service in a hospital. That's a number that is looked at as a key indicator of quality, not surprisingly. College and universities are looking at enrollment, the number of applications they get, how selective they are, meaning, it's almost like an application coverage ratio, looking at the number of applications compared with the number of available slots. And if there are 4 times as many applications as they have available slots, they can be more selective than another college or university where they only get twice as many applications as the number of slots that they need to fill. Graduation rates, the number of degrees that they provide, scores on standardized tests that their students take for graduate school, like the LSATs or the MCATs, where their programs rank compared to other programs around the country. And if we're talking about bigger colleges and universities, then they are really competing on a national basis as opposed to smaller local ones that may just be competing with other colleges and universities within their regional area. There's a lot of organizations that produce this type of information for comparison purposes. Healthcare, the American Hospital Association, the National Center for Health Statistics. On the college and university level, the National Center on Education Statistics is the place to go. If you're looking at transportation, you want to look at the Bureau of Transportation Statistics. There is this website called FedStats that is a place, it's one portal you can go to and be led to all these different federal statistics agencies that provide this type of information. Any type of BTA almost certainly has some type of industry association that is relevant to what it does. Wastewater management. I know that there's an association of water and wastewater entities. There's an association of housing authorities. an association of ports. Google them, and you're almost certainly going to find them. And many of them, if not all of them, uh, provide some type of valuable industry information that can be used for comparison purposes. And just to, in wrapping up, look at a couple of examples. Here's some information from Airports Council International on passenger traffic around the country. You can see the big hubs like Atlanta, Chicago, LA, Dallas, Fort Worth, Denver, New York, San Francisco, not surprisingly, have the most passenger traffic. Here's cargo traffic. If you're wondering why Memphis, of all places, leads by a substantial amount in terms of the amount of cargo that moves through their airport, I'm pretty sure that's where FedEx is. And that explains why Memphis is so high on the list here, higher than places you might expect like LA and New York and Chicago. For hospitals, you're going to look at information, about the types of reasons that people are admitted. That's what inpatients are. How long they stay. It's not surprising if you see somebody, who's admitted for psychiatric purposes tends to stay there longer because their treatment needs are more extensive or take longer to deal with than somebody who comes in for obstetrics. They're coming in to give birth, and so they don't stay as long as most other people do for significant surgery, for cardiology, for neurosurgery. This particular information that is provided by Yale New Haven itself shows what their average charges for each of these services are as well. And here's some information for outpatient utilization, also from Yale New Haven, the number of outpatients they have for a variety of different types of services, and what their average charge is for each of those services compared with the average cost of providing those services. For colleges and universities, here's some national information that shows the change in the awarding of degrees from 2000 to 2010, and you can see that it's jumped enormously across the board. The total number of associate's degrees by 50%, bachelor's degrees by a third, master's degrees by 50%, doctoral degrees by over a third, and then this particular table shows public versus private, and then within private, not-for-profit versus for-profit, and you can see that there's been a tremendous amount of growth in a percentage term from for-profit entities, and that growth actually explains a significant part of the overall growth as well. You can see that some additional 92,000 associate degrees provided by these for-profit entities like Phoenix, and that's a pretty big chunk of the approximately 285,000 increase. About one-third of the increase came from these for-profit entities, and that's why their individual percentage growth is so great. You see bachelor's degrees increased by 387%, master's degrees by 587%. So you can see that a lot of people in the last decade who are going back to school to earn an advanced degree, a lot of them are turning to these smaller for-profit entities to get that degree. Information about tuition and fees. This is, again, national summary information that shows you how tuition and fees have changed over time. They're shown two ways. Here are the current dollars, what they actually charged in each of those years, and then this information over here has adjusted that for inflation. That's what they mean by constant dollars. So it takes inflation out of the equation and looks at whether there just has been an overall increase in the cost that isn't related to the fact that it's more expensive to provide the service. And in fact, you can see that they went from, in constant dollars, from under $7,700 to almost $17,500 for all institutions. That's information that you could compare with an individual college or university that you're interested in looking at. That's just a couple of examples of the type of operating information that is out there. There are more examples of it in the analyst guide, that is the text for the course. I said that I'd say something very quickly at the end about regulated entities. There are certain business type activities, mostly utilities, that are rate regulated, meaning there is some governmental board, regulatory board, that limits the amount that those entities can raise their rates, and does that based upon what the expected costs are going to be for that entity, including capital costs like depreciation and the need to accumulate resources to replace capital assets, and so there is a different type of accounting that is done for rate regulated entities. It used to be that governments applied FASB Statement 71 if they were rate regulated. Those standards have been brought into the GASB's literature through GASB Statement 62, but the basic application of that guidance hasn't changed. It involves the reporting of regulatory assets and liabilities, and I'm not going to get into that in any detail here. As I mentioned earlier, there is a chapter in the textbook on it, but that's really the most that we're going to deal with that in this course. It's an entirely different type of analysis that is done that requires looking at these regulatory assets and liabilities that are hung up on their financial statements that are different from typical assets and liabilities. In fact, what they mostly are like are like deferrals. They're more like deferred inflows and outflows in that they're not liabilities in the sense that it's money that's owed. It's that there is a regulatory requirement that, for instance, they refund some rates because they've been able to collect more than they needed, but they're not going to have to do that all in one year. It's going to take place over time, and ultimately in the form of either a direct refund payment or a reduction of future rates. On the asset side, they're able to collect additional revenues because there's a large anticipated cost, perhaps a big upgrade that has to be done on a power generator, on a nuclear power plant, and therefore they are raising additional revenue through higher rates over a number of years in order to accumulate the resources they need to do that capital investment, and so that's essentially what they're doing is trying to match the raising of the rates to the year in which it's actually needed, and there's an understanding that the government can't call upon those resources for its general operating purposes because they've only been allowed to raise those rates for that purpose, and can use the resources that come from the raising of those rates only for that particular purpose that the regulatory body has allowed them to. That's all I have to say about regulatory accounting right now. It really is a topic that is beyond the scope of this course, and not one that you're likely to need in order to do the analysis of Orange County. So with that, that wraps up the lecture. The takeaways here, looking at BTAs, you can apply quite a lot of the same analysis that we've looked at for general purpose governments in terms of looking at things like liquidity and solvency and coverage, debt burdens. But because these entities depend almost entirely on their ability to provide the service they were created to provide and to charge for that service, the focus really isn't on the general health of the surrounding environment of the economy that the government operates in. Economic and demographic information, specific information, tends to be very relevant, but It's specific things that are related to the type of service that the BTA provides. And so most of the focus is on what service it's providing, how much it provides, what kind of demand there is, what competition there is from other entities that provide the same service, what fees do they charge, what's the base that they're charging against, which is very closely related to demand, if not exactly the same thing. And you know, the debt that they're issuing and securing with that revenue source, is the revenue source sufficient to repay that debt? How many claims are there on that revenue source? What other things is it used to pay for in terms of the costs of the government apart from repaying its debt? Uh, that's a very different and more narrow focus than you have when you're looking at a government's general obligation debt or tax-backed debt, when you are concerned about the overall health of the government and the economy that it's related in. So thank you very much, and that's the end of the lecture.